Matt MacFarland and Amanda Han. They own CPA, Keystone CPA. Matt has over 20 years of experience in public accounting as a CPA and tax strategist. He has worked for both the Big Four and regional CPA firms. Amanda has over 18 years of experience as a CPA with special emphasis in real estate, self-directing and directed investing, and individual tax planning. Amanda has extensive Big Four public accounting experience, and you can catch her book on Bigger Pockets, which I have read, Tax Strategies for Savvy Real Estate Investors. Welcome, Matt and Amanda.
Wow, thank you. Thank you, the Norris Group, for having us and putting together this great venue. And like Bruce said, we really miss all of you guys that we've seen over the past 10 years. So all of our clients, fellow investors, we miss you, and we can't wait to see you in person, hopefully next year. And so thank you for spending your Saturday morning with us. Today, we're going to be talking about a couple of things with respect to the potential tax changes. We're first going to go over some of the major things that took place this year as part of the CARES Act. And then we're also going to go over some potential tax changes that are being proposed that investors should know about. And then also we're going to be talking about some potential year-end tax planning strategies. I think we'll finish up with what's next? What are some of the things that we can do in times of uncertainty when it comes to tax planning?
Yeah, let's get into some of the changes that happened with respect to the CARES Act. That CARES Act was passed obviously earlier this year in March, kind of around the time that COVID came out. So some of the big changes to kind of be aware of is business loss limitations. So under the previous law, the Tax Cut and Jobs Act, if a taxpayer had net business losses for the year on their personal tax return, they were limited to deducting $250,000 against other income if they were single, or $500,000 if they were married. Now, under the CARES Act, it did away with that limitation. So now that if you happen to have more than $500,000 of overall business losses on your return, you can deduct more than that against your other income. The other thing that they did change is that they made it retroactive to 2018 and 19. So maybe as an example, we had clients with this, right, where they filed their 18 return, they've got a overall $750,000 total losses. They were only able to deduct $500. Well, now we can go back and file amended returns to get that extra $250,000 deduction. So so this is available for 18, 19, and 20. So if you find yourself in that situation with your 18 or 19 returns, you can look at filing amended. Obviously, with 2020, you're going to file that coming up next year. You can take advantage of that as well.
Yeah. Another change that came out under the CARES Act is that now qualified improvement property for commercial real estate is eligible for 100% bonus depreciation. And this is important because it essentially means that for these types of assets, you get 100% write-off immediately rather than having to wait for multiple years.
And when we say commercial property, we were referring to non-residential property, okay? So a lot of times people think apartment building, they consider commercial because for lending reasons or whatever. But when we say commercial, strictly non-residential, so office building, medical building, shopping center, stuff like that. Another change with respect to the CARES Act has to do with net operating losses. So under the Tax Cut and Jobs Act, they did away with being able to carry back net operating losses where you could only carry it forward. And they also applied a limitation where you could only offset 80% of your income when you were carrying a loss forward. Now, under the CARES Act, they did away with both of those. So now if you have a net operating loss, you can actually carry it backwards or forwards, and you would want to look at your situation to see which one is better. And you can carry a loss backwards 5 years. And this is retroactive again to 18 and 19 as well as the 2020 year. So again, if you have a net operating loss in your 2019 return, you could look at carrying it back 5 years to 2014, look at the numbers, work with your CPA to figure out, okay, what am I going to save by doing that? Or do I want to carry it forward depending on what my income might be for the following year?
Another one is charitable donation deductions are now 100%, so you can offset 100% of your taxable income. For those of you who are charitable minded, this is a really great opportunity for the 2020 year.
Yeah, so if you happen to have a big income year, before you were limited to deducting 60% against AGI. Now you can go up to wipe out your entire AGI.
Yeah. And like Kara mentioned earlier, a lot of changes to retirement distributions. This year, there are no required minimum distributions under the CARES Act, which is good for some of taxpayers if you want to lower your tax rates by not taking some taxable distributions. And then there are also some other ones with respect to CARES-related 401k loans as well as CARES-related distributions. And I'm sure we'll talk a lot more about that during the panel Q&A a little bit later on today.
So this is kind of what's happened on the federal side. We want to touch real quick on a state level. So obviously we all live in the state of California. Probably a lot of you listening may live in the state of California too, or if you have California properties, this may be applicable to you. So touching on California Prop 19, it looks like this is going to pass. It's kind of going in that direction if it hasn't already. There's two main parts of it. The first one we want to mention is with respect to inherited properties. So you'll see in the screen that we underline the effective date because this actually has a different effective date than the next one we're going to talk about. So this is going to become effective February 16th of next year. Now, with respect to inherited properties, the old rule was parents could pass property to kids, grandparents could pass property to grandkids. Didn't matter what the recipient used the property for. It could be primary, rental, vacation home, whatever. And then the parents were passing their tax base to the recipient. The change in the rule is that no longer applies to vacation and second homes. It really only applies to primary residences and farms. And something to keep in mind, though, is that for those primary homes and the farms, the property tax bill can still go up if the fair market value of the property is $1 million more than the property tax base. Now, it may not go up as much, obviously, if Joe Blow bought that property off the street, but it could still go up a little bit. So there's something to kind of be aware of there. And the other one with Prop 19 has to do with homeowners. So the old rule was, homeowners over the age of 55 could transfer their property tax base if they sold a property and bought a new one, but usually it was only if you sold it and moved in the same county. Now under Prop 19, that's changing so that that person can move anywhere in the state. And they can also buy a more expensive home, so you don't have to sell one for $300, buy one for $300 to take advantage of it. You could sell for $300, buy for $600, and still be able to pass your property tax base. And then you can also use this rule up to 3 times in your lifetime. So that's how kind of how Prop 19 is mentioned. I know Harry's going to talk about this a little bit more later on, so we just kind of wanted to throw those out there for you.
Now, one of the things, obviously, a lot of people are talking about are what are the possibilities of potential tax changes. And so historically, a lot of major tax bill changes passed during the first year of a newly elected president. So obviously that's what we're all paying attention to. But some of the other things to keep in mind that tax changes is not a law enacted by just one person. It's usually not through executive order or anything like that. So it is something that has to go through Congress. And so if we have a divided Congress, there is an expectation that maybe they might not get everything on that wish list of tax increases. Or rather, I would say our do not wish list, right, if we don't want that to happen. So there's an expectation, at least in the CPA profession, that yes, there will be changes likely, but maybe not anything too significant, and hopefully on a much smaller scale because of the fact that negotiations are needed, likely to get anything to be passed.
Right, and part of this, too, comes down to prioritizing issues, right? I mean, the country is facing a lot of issues right now, so if there is a newly elected president or Congress or what have you, they got to think about what's going to be the most important issue they're going to deal with first. Obviously, we're dealing with COVID-19. We've got unemployment, the economy in general, healthcare, whatever you want to name, it's on there. And then throw on top of that tax changes. Now, obviously, under the Biden administration, they did throw out a lot of tax proposals we're going to go into here in a second. But again, is that going to be first and foremost on the list? We don't know.
Another question we're getting a lot from clients, timing. When are these changes going to take into effect? First question is, can any changes next year be retroactive to 2020? And might be shocking to some people, but the answer is yes. In the past, there has been precedence of tax changes being retroactive. And if you've been paying attention earlier, we talked about some of the CARES Act tax changes were retroactive to 2018 and 2019. However, although there has been precedence for that, I don't think a lot of people are thinking that will likely occur for anything or any tax increases to be retroactive to the 2020 year. Then the next thing we look at is how likely is it for 2021? Meaning, if tax changes were to be signed into law later in 2021, would it be retroactive to January 1st, 2021? And I feel that the odds of that are much higher. It would probably relate to specifically what are those tax changes. So if it's more transactional things, it might be for a certain cutoff date and starting forward. If it's major things like tax rates and things like that, odds are it would apply retroactive to the beginning of the year. And then there's this third possibility of a potential phased-in tax increase, whereby there are tax law increases signed into law in 2021, but they may take effect over the next couple years. And the reason for those types of things historically is because you're trying to balance other things, such again as COVID or stimulating the economy. So doing that in more of a phased-in approach is maybe a way to not have a major disruption to the economy as a whole. Okay, but again, we don't really know when it's going to be, but these are some of the the three possibilities in terms of when.
Yeah, if anybody has a crystal ball out there, please let us know. I mean, obviously, from a planning perspective, we'd hope that, from a tax perspective, we would hope they make decisions sooner than later. But, looking back at the Tax Cut and Jobs Act, that was passed, I believe, on December 29th or 30th of 2017. And it was, more or less made retroactive at the beginning of the year. So this does happen. It is shocking sometimes when a whole year goes by and someone changes the tax law that you were planning on, So.
Yeah. And I think for all of us, we probably like that third approach the best, right? Phased in so that we have time to plan. We know what's coming up. And just even in talking to our panel earlier today, we're all planners here. And it is very unsettling in these times where there's so much movement that we're just really not sure what is going to be, likely to happen.
So we're going to kind of move into, looking at some of the potential changes and keeping from the perspective that if the Biden administration takes over, or the Democrats take control of the House and the Senate, that's kind of we're going to talk about some of the proposals they threw out there. So first, we want to just kind of throw up their marginal tax rates, okay? So on the screen, you can kind of see we've got this graph that shows a column of the 2017 rates were pre-Tax Cut and Jobs Act. You're looking at what 2020 looks like right now. And then we've got a 2022 question mark column. Now, is it 2022? Is it 2021? Could be later, could be never. We don't know. But if it does pass based on what they were discussing or promoting, these are what your rates could look like. Now, this is for a married couple. It's totally unknown what it would look like for a single person. But the main difference here, you can see right around that $400,000 mark. That $400,000 number is going to be a key number to keep in mind. Is that right around the $400,000 mark, that 35% bracket goes away that we currently have, the 37% bracket goes away. It jumps all the way back to 39.6%, which is the rate we had in effect pre-Tax Cut and Jobs Act. So they're really wanting to tax kind of that higher end of income, right, above $400,000.
Yeah. And then the next slide is the potential changes to capital gains tax rates. This is a huge one, of course, for a lot of us who are real estate investors and also for a lot of our clients that are in the stock market. And so this is a significant change that basically increases the capital gains rate from the current 20% up to 39.6%. I know earlier Dino was going to talk about 1031 exchange, the potential issues with that. So these are certainly things to keep in mind to see if any of these proposed changes actually come through, and possibly a big planning area to consider, even maybe between now and the end of the year.
Yeah, and as you can see, this is looking forward. This would apply if you happen to have total income, and how do they define total income? We don't know. We think it's taxable income, but if taxable income is above $1 million, and you're going to have capital gains, your capital gains could be taxed at 39.6% instead of 15 or 20% right now. I mean, that's a big difference, obviously. So that's something to keep in mind, keep your eye on as things move forward. The next one that they were discussing was an expansion or change to Social Security tax. So right now, if you are a W-2 employee, working for somebody else, work for yourself, whatever, the first about just under $138,000 for payroll taxes on your W-2 or earned income is going to be taxed at 12.4% for the Social Security tax. But after that, the Social Security tax went away. There's still a 2.9% tax, that's the Medicare tax, but the actual Social Security tax went away after $138,000. But the proposal is to bring it back once your W-2 or earned income exceeds $400,000. So you can kind of see there's like that donut hole there, right, between $138,000 to $400,000. I got donuts on my mind or something, but so between 100, that's the key there, right? Is if they're going to put this in, if your W-2 or earned income goes above 400, you're going to want to work to find a way if you can, and if you have your own business, and justify a lower salary to bring it under $400,000, so it doesn't start getting hit again by that 12.4% after $400,000.
Yeah, I think for this one, there's going to be a lot of potential planning areas, like Matt said, for individuals who might currently be operating as sole proprietors, Schedule C, to then try to move into sort of an S-Corp structure where you can have better control over that payroll amount, so you remain underneath that new threshold. Just another note on this, because this proposal is it impacts Social Security, it does need 60 votes in order to pass. So again, the likelihood of that passing is very unknown at this point. So another potential tax change that is proposed is the Section 199A, and a brief recap is basically for certain types of income, the first 20% of that is currently tax-free for certain taxpayers. Some examples of that with respect to real estate is certain types of rental income, okay, for some taxpayers, property management, acquisitions fee, realtor commissions. So some of those income right now for a lot of taxpayers are potentially at zero tax. And part of the proposal is to further phase those out for individuals making over $400,000. And as you've seen, there's a theme here of this $400,000 threshold. So I imagine from a planning perspective, on a go-forward basis, one of the things we want to be looking at is what are all the things we can do to keep income under 400, right? Retirement contributions, depreciation, all these other strategies.
I think this one could have a big impact, because we have clients that, specifically I'm thinking like a realtor, last year probably made $800,000 in their business, and a good almost 20% of that income, based on there are some limitations, but almost 20% of the income was totally tax-free. So now if you fast forward and this passes, the benefit is not going to be as great as it was before. So it can definitely have a substantial impact on people's returns. Another thing I want to mention on the itemized deduction side, they are talking about putting a cap on itemized deductions. Now, right now, there is no overall limit on how much itemized deductions you can take. What they're discussing is putting capping the benefit at 28%. Now, how the mechanics and the calculations work obviously is totally unknown, but in theory, kind of what we think is like if you find yourself, if we go back and think about that chart of the rates before, you find yourself in the 32 or even the 39.6% bracket, you're making income, paying taxes at that rate, and you got your itemized deductions, they might cap it so that you're only effectively getting a 28% benefit on all your itemized deductions. So there's going to be that arbitrage there that you're not offsetting one for one, unfortunately.
I guess one potential good news is that there
Give us some good news.
There are indications that maybe the current state and local tax limitation might be repealed. So currently, for itemized deduction, we are capped at $10,000 in total for our primary home property tax as well as state income taxes. And that has been hugely detrimental to a lot of our clients who live in high taxing states and high valued homes, states like California, New York. And so there's a possibility that the limitation may go away and we may revert back to pre-tax cuts days where you can deduct all those personal home and state income taxes to offset federal. So hopefully that one comes through. Just a couple other brief ones to mention. There's in the proposal, there's a first-time home buyer tax credit that might take into effect, and also a new tax credit for homeowners who rehab distressed properties that are in distressed areas. So this is an interesting one, especially we have clients who do house hacking, and kind of combining that with primary home gain exclusion and turning your home into a rental. I can see there might be a lot of creative and fun tax planning surrounding this area if it were to pass.
Another one they're talking about is making some changes to the estate tax. So they're talking about bringing the estate tax back to like 2009, kind of circa 2009, which means that the exemption would drop from more than 11 million per person down to 3.5 million. And then also they're bringing the rate back up to 45%. So I imagine, Harry may talk about this a little bit more later, but that was something to be aware of. And the big one is they're also talking about possibly doing away with the stepped up basis. So for those of you who don't know, stepped up basis is just if you have a highly appreciated asset, you've held on to it until you pass away. When your family or whoever inherits it from you, they can actually sell it the next day and not pay any capital gains taxes because the tax basis gets moved up to the fair market value, and they could sell it and have no income taxes, which is a great thing, obviously. But so they're the part of the proposal they're talking about maybe taking that away, unfortunately.
So I guess the 1031 exchange, right? Also something that's on the minds of a lot of investors and CPAs as well, in terms of what the potential changes are going to be. Is it going to be phased out? Is it going to be taken away? And I know Dino's going to be coming up next and talking a lot more about that. So we'll look forward to hearing what she has to say. I think one of the questions is that we're getting from clients and even for ourselves is, well, what does all this mean, right? Matt and Amanda, you guys talk about where we are and what we'll potentially be. But what does that mean? What do we do now? And I think the first step for each of us is to try to look ahead into 2021 and think about or project out where do we think our income is going to be. Okay, just because taxes are going up doesn't necessarily, tax rates are going up does not necessarily mean taxes are going up for you as a taxpayer. So the answer to that question will be different for each of us in the room and for you guys in the audience. So first is to think about where you think your income is going to be next year. But we've put together kind of, two scenarios. If you think your taxes are going up versus if you think your taxes will remain the same. What should you be doing today?
And remember, this is what you think your tax is going to do, okay? You
Not
shouldn't
Bruce's
be,
taxes.
yeah, you don't care about Bruce's or Karin's taxes necessarily. So, all right, so if you don't think your taxes are going to go up, then what we're looking at is, focus on the traditional year-end strategies, right? So looking at deferring income to, next year, right? Why pay taxes sooner than you have to, right? On the flip side, we always talk about prepaying expenses. Get the deduction. If you know you're going to have an expense in January or February, look at prepaying that expense now so you can take the deduction now.
Yeah, and the whole concept behind that is usually we want to save taxes today for next April rather than waiting a whole year to save on the taxes if we think our rates are going to be the same or if even lower. This year, like we said, there's still bonus depreciation, 100% bonus on certain eligible assets, so take advantage of those to lower your income more. And Karin talked earlier about all the wonderful benefits of retirement investing. So consider, maximizing retirement contributions. This year, we could still save taxes based on our effective or marginal tax rate, right? And that might change a little bit, which I'm sure Karin will talk about later. So, these are all the traditional things that we typically look at.
And then also look at harvesting losses. Now, when we talk about harvesting losses, there's a lot of different ways to look at it. You could look at capital losses. Maybe you've got some capital gains from selling stocks during the year, and you've got some ones that have gone down in value that you could trigger the capital loss year to offset your capital gains. What about passive losses? Maybe you've got some unused rental losses carrying forward on a property that maybe it's not, maybe it's performing okay, but maybe if you sold that property, bought a better performing asset, you would be able to release and deduct all those carry forward losses related to that property. That could be a way to use those losses to offset other income. And then the third one is just net operating losses, right? We touched on it a little bit earlier. There's a lot of opportunity right now. Remember that we talked about the CARES Act. The net operating losses can be carried back or carried forward. That carryback is only available for 18, 19, and 20. So if you've got some, you had a high tax year in 15, and, I know 2020 is a lower income year for some people or a lot of people just because of COVID and everything. Maybe this might be a year to kind of, play with your numbers, figure out where those numbers are going to be at the end of the year, trigger some losses if you can. That might give you the opportunity to carry your losses back to 15 and recoup some taxes you paid back then.
Yeah. Now, of course, for a big part of our presentation today, we did talk about taxes going up. So if you think your taxes are going up, then here are a different set of strategies to potentially consider as we head into the end of 2020. And you can see on the slide, it's basically a reverse of the previous slide, right? So instead of deferring income, we're
pretty creative like that.
Yeah, we want to accelerate income, whether it's rental income. I mean, good luck, right, if you can get your tenants to pay you ahead of time. Accelerating income, accelerating capital gains. If I'm going to sell a property and next year I'll pay 39.6% in capital gains, maybe I want to sell this year so that I'm still within maybe a 20% tax rate. So, accelerating income if we think our tax rate will be higher if it's earned in next year. And on the flip side, of course, don't defer expenses as much as possible, because we want to keep our write-off into 2021 if we think we're going to save at a higher rate.
So that goes along the lines of the bonus depreciation we talked about earlier. It's like there's times where, you can take bonus depreciation, but you can also elect out of it. So that might be a situation where you're not trying to maximize current year depreciation. Retirement distributions.
Yeah, we talked earlier about how under the CARES Act, there are no required minimum distributions this year, but you might want to take some distributions out anyway, because of the fact that you are expected to pay higher taxes on that next year. So that is certainly something to consider. And of course, under the CARES Act, for certain eligible people, you can take up to $100,000 worth of distributions out and potentially avoid penalties. So again, just looking at different ways to accelerate income if you think your tax rate is going to shoot up significantly next year.
Now, those coronavirus-related retirement distributions, that penalty-free exception applies for distributions taken this year. So if you take one on January 2nd because you were affected by coronavirus, that law, unless they extend it for some reason, is you would owe a penalty next year if you did the same exact thing versus doing it on December 30th. So we don't necessarily always recommend taking money out of retirement distributions if you don't need to, or retirement accounts. But again, you're looking at your income. If your income's lower and you can get access to the funds and utilize them in a good and efficient manner, this might be a year to do that. Along those same lines is a lot of people are looking at Roth IRA conversions right now. If your income happens to be, like I said, if 2020 happens to be a lower income year for you, and your taxes, or you think they're going to be higher in the future, even, fast forward 20 years into retirement, if you're in a 12% or 22% bracket now and you think you're going to be at 40% in the future, now might be a year to move some money from that pre-tax bucket to that tax-free bucket so that it can pay taxes at a lower rate and have it grow tax-free for the rest of your life.
Yeah. So we just want to end with, what's next? Well, it's, really planning time. I know it's difficult to plan in times of uncertainty, but the first step is to, try to project out where you think you're going to be income-wise for next year. And obviously keep an eye, on what's coming down in terms of tax changes. Stay in close contact with your CPA, with your tax advisor, to let them know of any income or expense changes you have coming up. And then lastly, just to take advantage of the tax benefits while they exist, right? The first part of our presentation, we went over all the benefits of the CARES Act tax changes. Those are things that are known, so make sure you take advantage of them today while still available.
And Christmas is coming up, the shameless plug for our books. Bruce mentioned that Amanda wrote this book, so I am also listed as an author, though. I just wanted to give myself credit for that. So thank you again, everyone, for listening and participating. We're looking forward to the Q&A, and appreciate, again, the opportunity to speak for you.